So, commencing with case study 1. So here are the fact patterns. As usual, we always start out with a hypothetical fact pattern for these particular case studies. So in this case, we have Akash, who's married to Sapna, and they have one child, Anika. Akash has a trading company in India, a depository account or an account, and is also domiciled, resident citizen domiciled in India. Akash also has a UAE trust, and for today's purposes, we obviously have different financial free zones in the UAE, but we'll concentrate for today's purposes just on the DIFC. So we'll assume that we have a DIFC trust which holds an account, and we have a company in the UAE. We also have an account in the US, as well as land in the US. And then lastly, from the UK perspective, we have an account and UK land. So these are fairly standard fact patterns. But the key aspect here is Akash is Indian citizen, resident, and domiciliary. Okay, so totally domestic individual with a domestic family, so that the family are not internationally spread. So unusually on these virtual roundtables, we don't generally go into tax, but in this case, we're going to look at the tax compliance aspects as an additional feature. So from a tax compliance perspective, looking at it from an Indian standpoint, I think what we'll discuss is the following: the scope of domestic taxation, income gains, and particularly if there's any inheritance taxes. The basis of taxation in India, is it global territorial remittance? How does it work? And the attribution of taxation. And here we're really looking at things like a CFC-like rule for the UAE trust income and gains. Can that be attributed? Likewise, the attribution back to India for taxation on UK and US investment income. And then finally, and then I think this is going to be a theme of this particular PRT, is what can we expect from an Indian tax administration perspective in respect of the recovery from COVID-19 and how it may affect high net worth families. So I'd invite Shira to just take us through from the top, the scope of domestic taxation right through to the basis and then the attribution and the COVID recovery.
Sure. Thanks, Zach. So on the first question regarding the scope of domestic taxation, India, like several other countries, taxes its residents on a worldwide basis, and it taxes its non-residents in relation to their Indian source income. We don't have worldwide taxation based on citizenship or domicile or any other factor. So it's primarily based on the physical stay and the number of days that a person would have spent in India, on the basis of which they're determined to be resident and then taxed on a worldwide basis. A similar rule applies for capital gains as well. We don't have an inheritance tax in place at this point in time, but it is likely that if and when it is introduced, that we would follow a similar scheme to what we do in our income tax laws as well. Although that's of course hypothesizing at some level. The basis of taxation for Indian source income can be, it can trigger on a number of situations. So remittance could be one of the situations in which it triggers, but it could also be if the income accrues or arises in India or is deemed to accrue or arise in India based on certain factors. So for example, for capital gains, if an asset is situated in India, then it would typically be considered to be sourced in India, irrespective of the location of the asset holder. And so you would need to look at the source rules as are applicable for individual assets or individual sources of income. The next two questions are actually a similar question. So on the attributed tax of UAE trust income or attributed tax of UK US investments, what we need to keep in mind is that India does not have CFC rules in place as of this point in time. So what you would be looking at is whether this offshore company, if it's a company, can be considered to have its place of effective management in India. And the way in which India determines this is similar to how it would be determined under the OECD treaties, although there are a couple of points of departure. And for trust income, we don't have a specific residency rule that tells us how offshore trusts would be considered resident in India or how their income would be attributed to India. So there are a couple of possibilities that could apply. One is if an offshore trust has even a single trustee in India. So say there's a board of trustees with a majority of them being non-Indian resident, but with one Indian trustee, then one of the provisions in our residency rule says that if even a fraction of the control and management of this offshore entity is in India, then it could be considered to be resident in India and therefore taxable in India on a worldwide basis. Now, this provision isn't applied specifically to trusts, but it does apply to non-corporate, non-company entities. So this is the rule that applies to partnerships, for instance, and therefore there is a possibility that it would be extended to trusts as well, since trusts are not considered to have legal personality in India. So short point being, trustee in India could be a potential situation where an offshore trust is taxable here. Another possibility is if all of the beneficiaries of an offshore trust are resident in India, and this is if it's a discretionary trust, or if it's a specific trust with some beneficiaries resident in India, then what would effectively happen is that the trustee who is considered a representative assessee of these beneficiaries could be considered taxable in India because of the residency of the beneficiaries in India. And that's something that would need to be examined depending on the details of the trust structure, whether the beneficiaries can be considered to have fructified claims in the underlying distributions and so on. Other than these two broad rules, we don't really have too many rules for notional attribution of income. Although you would need to keep an eye out for it because CFC rules were in contemplation a few years back, and I wouldn't be too surprised if they're introduced at some point in the future. Um, on the last question, Zach, post COVID-19 tax administration responses, we have had some relief introduced for in relation to individual residency. So we had some communications put out last year that if individuals were stuck in India due to travel restrictions, and we had pretty prolonged quarantine periods after COVID started. So what this communication says is that if they were unable to leave India during those specific periods, then those periods would not be counted in relation to the determination of their individual residency. What the communication does not do is provide a similar relief in relation to permanent establishment exposure. So in a lot of our treaties with other countries, for instance, you would have number of day requirements in relation to when a PE comes into existence. So for example, it could be a 90-day requirement if it's a service PE, for instance. And there's been no relief that's been provided on that front, which could potentially create permanent establishment exposure for some kinds of offshore entities.
Right. In terms of the post-COVID response, do you anticipate, or have there been any sort of soundings that the Indian Revenue Authority will become a little bit more aggressive on avoidance behavior and sort of tax planning that they feel is aggressive? Or have they, have we got any indication of a timeline for inheritance taxes or potentially a CFC introduction? How are you seeing that shaping up?
So CFC is an issue on which there's not a lot of conversation today, to be honest, although we did have draft regulations put out a few years back. Inheritance tax, on the other hand, is discussed every year, every time the budget comes out. Although the word on the street is that with the economy as it is right now, and the period of slowdown as it is, it's unlikely that the government will introduce an inheritance tax at this point in time. Although the financial incentive for it exists because it would obviously contribute to revenue at some level during the period of slowdown, I think they're also conscious of the fact that it would have an impact on sentiment, which they don't want at this point in time.
Right.
So I would be surprised if they introduce it this year, although it's definitely something that's been on their mind.
Right.
On the issue of avoidance, I would not think so. I mean, although this is not the kind of thing that they tend to put out in public domain. Like I said, there is a general sort of concern around the sentiment and the economic slowdown. So I think that would reflect in terms of the attitude of the tax authorities as well.
Right.
Hopefully.
Okay. All right. Thanks very much, Fiona. So what we'll move on to is we'll look at the tax compliance aspects in the UAE, and there's a couple of questions that I'll ask here. The scope of taxation for foreign ownership, and in the UAE in this case we've got Akash owns a company and he's also settled a trust in the DIFC, and the trust holds an account. So we're looking at the basis of taxation for those entities where there's a foreign element, and then the exchange of information under the CRS, and that's looking at the whether or not there's a live bilateral agreement under the CRS between the UAE and India where information can flow. And in this case, probably the candidate is going to be the underlying account of the trust or the trust itself. And then sort of invite Diana to mention what we can expect from the UAE in terms of its post-COVID response, particularly when it comes to foreign investment into the UAE. So I think we'll just kick off with the scope of taxation where we have a foreign element, foreign ownership of a company, and then obviously a foreign settlement of a trust and potential beneficiaries of a trust, and then the exchange of information on the CRS. So Diana, if I could invite you to help us through this.
Thank you, Zach. Hello, everyone. So the UAE has always been known for a tax-free country. We've never really had tax in our lives, except for now for the last 2 years, since the GCC has come up with its own VAT tax. The VAT is mainly not the kind of tax that would be on income or of that sort. It is just a VAT, and in the UAE it's still at 5%. So when I look at the assets that Akash has in the UAE, he has a DIFC trust, but he has a property or a company. They may be onshore. So it's not really clear here for us, but the most important thing in the UAE is to look at the onshore and offshore in order to decide how does the tax work. The VAT is onshore, mandated, obligatory, the 5%, but on the trust, there is no tax. So it's the trust is VAT free.
Right.
Now, yes, so far, this is what we can see here from the assets that Akash owns. Now, the CSR, we know, as far as the trust is concerned, there are strict rules in the DIFC on CSR, and failure to comply would lead to some penal consequences. Now, does the UAE and India have a treaty of that sort? I don't believe that the treaty is required here, because the CSR rules are applied in DIFC regardless, as long as there is an account owned by a trust in the DIFC, the CSR rules would apply.
And in the post-COVID, do we think that the UAE is likely to, in any way, change some of these tax-free bases going forward, or do you think that it's going to be more encouraging to foreign investment into the UAE?
Well,
worth individuals.
I'm glad to say that so far we did not have any initiatives or any measures as far as tax is concerned. In our neighboring state, like the Saudi, they've put their VAT immediately at 15%, but the UAE is still keeping the 5%. And luckily, just to attract foreign investment, I think that is a very wise step.
Right. Okay, thanks very much, Dan. Now, the US side. So here's a question from the US, because obviously Akash holds an account, and he also has property, land in the US. So scope of taxation of foreign ownership, exchange of financial account information, FATCA, so looking at the Indian US FATCA arrangements, and the recent US foreign landlord enforcement action, and what that looks like, particularly if the US land is let out commercially. And then the US tax implications from the recent election for an Indian individual that holds assets in this way in the US. What can they expect to see, if anything, in terms of the treatment being changed? So I'd invite Ivan and John to just make some comments.
Sure. Thanks, Zach. You know, from a US perspective, have to start off always with the idea that US is a bit unique worldwide taxation on US persons. But in this instance, we have a non-US person that's owning these assets in the US. So non-US persons still are liable for US tax. The US system will break down into 3 tiers. So federal level, which is most of what we'll be talking about today, but there's also state level, and then in some instances, local or city level taxes that could be at play. We'll touch briefly on those and more substantively on the California side later in the presentation. But just keep in mind when we talk about the tax effects here, we're talking about 3 tiers, and then we'll divide it into income taxes and then transfer taxes, estate and gift taxes. So in this particular instance, you've got the account in the US. The non-US person could be liable to US tax to the extent that that account is holding US securities. What the liability is could be just a straight withholding if we're talking about simple, ordinary dividends and interest paid off of holding those securities. It could, however, be exempt if we're talking about capital gains, because the US takes the opposite position, if I understood correctly, that India takes when it comes to sourcing. It's not about where the asset is located. It's about the residence of the individual who sells the asset and realizes the gain. And so the US wants to incent investment into the US, so they relieve a capital gain liability from non-US persons. That's the general rule. When we look at the other asset in question here, the real estate, we're now dealing with the exception to that rule, though. The US has reinstituted a capital gain equivalent called FIRPTA, Foreign Investment in Real Property Tax Act. It's basically just a capital gain on US real estate that's bought and sold by non-US persons. So in this instance here, we'd have withholding tax on dividends and interest that's paid off of the account. The exception there also, portfolio interest. So bonds, most bonds, when they pay out, wouldn't have that withholding obligation. Again, another incentive to get non-US investment into the US debt, into US debt instruments. And then on the real estate, any type of rent that's charged is going to be ordinary income, US sourced. You'll have a liability. That regularly wouldn't be handled by withholding. Most US persons that are renting a home from someone don't realize that they would have a withholding obligation. They'll just pay the rent. So the recipient's going to file what's called a 1040 NR, or a 1040 non-resident return, and pay US income tax on the rent that they received on the property. Then if they sell the property, they'll owe on the capital gain. So the spread between the purchase acquisition cost of the property and then the realized sale price when they do sell it. And then overarching over all of this is a transfer tax liability. So US persons have a worldwide transfer tax liability, estate and gift tax, any asset they hold. As an example, if I hold an asset while I'm living in Singapore and I gift it to someone, or if I die holding it, I have US estate tax exposure. However, I have a very large 11.58 million lifetime exemption. So most US persons are subject to estate tax on their worldwide holdings, but will never actually pay it because they won't accumulate over 11 million in assets in their lifetime. But a non-US person, like we have in the situation here, has still a US estate tax liability only to the extent that they're holding US situs assets, but a very small exemption, only 60,000 US dollars. So anything above that, they would be subject to US estate tax. Here, the land is most likely and the building most likely worth more than $60,000. So you would have a US estate tax exposure to the extent that it's held directly. If it's not, there's a fairly straightforward and simple workaround here, is to hold that land on the other US situs assets like the US stocks and securities, hold that in a minimally in a PIC, an offshore company, or maybe combine that underlying company with a trust of some sort like we have in the example above. That's a shielding technique for that exposure. When it comes to exchange of information, the US is not participating in CRS. So they have FATCA, they're getting data about US persons around the world that have financial accounts or are controlling persons of financial accounts. However, don't get lulled into a simple yes, no answer on that, because while they're not participating in CRS, there are reciprocal arrangements available to any country that wishes to enter into it with the US. And an example here in the country that I'm in right now, Singapore, recently switched from a non-reciprocal intergovernmental agreement to a reciprocal. So when that goes into effect, Singapore will now start to get data from the US as to Singaporeans who hold accounts in the US. Now, it's not one-for-one data. So the type of very onerous and rigid rules that FATCA and CRS put in offshore, those have not been implemented internally in the US. For example, trustees of US trusts do not have most of the onerous reporting obligations that fall on offshore trustees. However, as Zach highlights on the slide here, the US has started to become more aggressive in their enforcement of FIRPTA, so identifying non-US persons who own real estate and might collect revenue because of it. So we're hearing rumblings that this could have a connection effect with FATCA reciprocal agreements. The US could become the first country to start to lead the way in exchanging data around values of real estate holdings, which are currently not used in the calculation of the CRS data that is set, either from an FI perspective or a controlling person of an NFFE perspective. So just something to be careful and watch out. If somebody talks to you about the US doesn't participate in CRS, it's the last great jurisdiction for you to legitimately and correctly hide wealth, that may be true in the short term and in a very technical reading, but the devil's always in the details, and you don't want to spend a lot of time and money to structure yourself into something if the primary intention is preserving privacy, if you know that a reciprocal agreement could be signed at any moment, or there's a heightened attention being paid by the US to foreign ownership of real estate, which could result in a reporting of that value that would not otherwise be reportable under CRS in a different jurisdiction.
Yeah.
And then go ahead. Yeah.
From my understanding, is it right, and also Tria for you, that the FATCA arrangement between the US and India it's on a reciprocal basis? Is that correct?
That's right.
Right.
Yes.
So in this instance, we would have the US financial institutions would be exchanging information with the Indian tax authority on what Akash is effectively getting in the US, whether it's interest or dividend. Is that right?
That's correct. And in fact, the Indian tax authorities have also put out communication to this effect, where they are coordinating with the regulators on the kind of information disclosure that we would be making and collecting information in relation to.
Right. So John, on to the election implications for Akash holding land and investments in the US, what sort of, in brief, what do we expect? Is it going to get bad for him?
Yeah, it could. So I'll give you the downside, and then I'll kind of maybe make people feel a little bit better with a brief discussion, as I mentioned at the start, with the political practicalities. So from the worst case scenario, or the downside here, the ordinary income tax rates that will be in effect on rental income that's being charged on the property, those could very well rise under the new presidency. We could also look at loss of basis step up. So when we talk about normal foreign grantor trust planning, holding property for next generations and them taking it at a stepped up basis, that could be eliminated. And so you wouldn't have the next generation. You would have an estate tax exposure of some sort, a wealth tax equivalent, but no step up in basis. So then the next generation would also face that capital gains tax, not if they're exempt. Okay, but again, we've got the FIRPTA that would put it back in with real estate, and then with a lot of this planning, sometimes the people will send the second or third generation family members to the U.S. and they become U.S. persons, which expands the liability. Now, having spoken about that increase in the potential exposure on both an income and a transfer or estate tax side, the practicality right now, as the lay of the land sits, is that the Republicans will maintain control of the Senate. It appears that it's 50 to 48 at this point, with 2 special elections that will come at the beginning of January in the state of Georgia. If the Democrats were to win both of those seats, that would be a 50-50 tie in the Senate, and a tie in the Senate is broken by the vice president. In this case, that is Vice President-elect Kamala Harris. So the Democrats would have control under that scenario. However, the state of Georgia is a rather conservative state, and both of the individuals who were in the runoffs from the Republican side, the Republicans garnered a much larger amount of the vote than the Democrats. The reason it went to a runoff is neither candidate got the required 50% plus 1 to not have a runoff. So they were below 50, but they were the overwhelming leader in the race. So it's not likely that Senate control will flip, meaning it will be tougher for any of these changes to actually go into effect. So we would expect that the status quo would maintain for at least 2 years. But if the last year or 2 years has taught us anything, making predictions can be utterly folly. So we just have to wait and see how those runoff elections occur.
Okay, thanks very much, John. So just going to the UK side, and I'll go through this quickly so we can get on to the sort of meat of the cross-jurisdictional aspects. From the foreign sort of scope of taxation from the UK, the CRS, as well as post-COVID. I think it's pretty much like the US and the UK, you'll have source related income. Obviously, the India and the UK have a double tax treaty in effect. For instance, Akash here would be entitled to his personal allowance in the UK. Any source income, so if it's dividends, there'd be no tax deducted at source, but if it's interest income, there'd be some deduction, although the treaty will have an effect on how much can be deducted. And on the UK land, if it's not being held through a company, and of course, Akash is a citizen, resident, and domiciliary of India, so we have no UK complications in that regard. If it is being let out, it will be subject to the non-resident landlord scheme, and in that instance, Akash can try and opt to have rental payments paid gross so that he can actually pay the tax later on. Otherwise, the letting agent will be the person that will likely do it, or default of which any tenants. But in this case, the scope of taxation is very much on a source basis. There's no other connectivity other than the assets in the UK. From a CRS perspective, UK and India are fully live on CRS, and there is an exchange each year. That's been by virtue of the multilateral competent authority agreement agreed between the 2 jurisdictions. And they were both effectively quite early on in terms of the adoption of the CRS. So this has been going on for a number of years now. Post-COVID tax administration response, nothing really to report yet on this. There's obviously been some tweaking on sort of non-residents owning properties in the UK and some SDLT or stamp duty hikes for that, but nothing targeted at the moment. Perhaps we might have some of this discussion that's happening at the moment with wealth taxes, and that may affect the UK property land, but it's too early on to see if the high net worth segment are going to be specifically targeted as part of a COVID recovery plan for the UK. So fairly similar to the US, although not necessarily as aggressive.